Today, companies are staying private longer than ever, so the typical route to liquidity via IPO is changing. The need for liquidity before a company gets to its IPO has become increasingly important for early shareholders, especially early employees. Today, there are around 1,200 unicorn companies globally, and these are companies generating significant revenue. 10 or so years ago, these companies would have gone public, allowing founders, VCs, and employees to convert their early investments into material wealth. Today, however, with the abundance of venture capital, there's less of an incentive for companies to go public. There's also financial cycles that delay timelines for IPOs, which aren't in the control of any investors. This means some employees are left waiting for up to 10 years to turn paper wealth into material wealth. Considering the current market environment and the broader financial considerations weighing on all of us, keeping morale high at these companies may require letting the employees benefit from their equity sooner. While considered the holy grail for many employees, stock options can be quite complicated. In this link to learn, we do a deep dive with Ben and Dan here into the world of equity compensation and how early investors and employees with shares or stock options can achieve liquidity. Dan and Ben will walk us through what the different types of incentive compensations are, and they'll walk you through how stock options work, what kind of tax implication one wants to look out for before it's too late, what kind of timing one should consider about when to sell, and when and how you can sell your shares. So I'm thrilled to introduce these two. They're both really impressive. Dan Idzkowski is partner at LvlUp Ventures. He's a 5-time founder, a venture capitalist, an inventor, and a financial quant guy. Dan is a deep thinker. He spends his vocational time founding, funding, and advising mission-driven companies that are tackling some of the world's biggest problems. Dan's deep expertise is in fintech, wealth tech, and deep tech. Most recently, Dan tackled the big problem for investors in public markets that they're not even aware of, that a 50% dip in the public markets requires 100% return to recover what was lost. Dan was inspired to design a tactical asset allocation system, which is empirically proven to reduce losses in bear markets. This gap in the market inspired him to launch SidePocket, the only deep tech-enabled investing platform solving the drawdown problem at scale. Dan gives back to other entrepreneurs by lecturing and mentoring at the Founder Institute, 500 Global, and the Alchemist Accelerator. Ben Kromnick is the managing partner at LvlUp Ventures and head of partnerships at Dealmaker. Similar in the way that Ling2 is democratizing access to private market investing, Dealmaker is disrupting the private equity markets and democratizing access to capital by enabling companies to raise from their communities and customers. That's very cool. Dealflow is Canada's 3rd fastest growing company and been dubbed the Shopify of the capital markets. Ben is a product and strategy leader with experience in fintech, health tech, collaboration, insurtech, wearables, and AI industries. He works at the confluence of major social change and the application of big data and AI to impact the world. So with that, I'm going to hand things over to you guys. Take it away. Can you maybe start us off with how stock options work for employees and what all the things they need to consider?
Sure. Ben, do you want to kick us off? I woke up a little under the weather, so I'm trying to conserve my voice a little bit. Just waiting for that.
Dan, we were both at the same event last night, so now I'm worried.
Yeah. I think it couldn't have been, in one night, but a little congested.
Yeah. Sure. Look, I'll get us started, and then we can talk about it. The world of equity compensation is so broad and so detailed. We're not possibly going to get into every space. So I know one of the things I'm probably going to focus some of the conversation on is how can founders create liquidity events for their employees as they go forward and as their company progresses. Right? You don't always need to IPO in order to pay out your employees. So it's one of the things that I'm going to try to focus a lot of the conversation on. I'll talk about some of my own personal experiences as well, as a venture-backed founder, but also as an early employee at scale-ups. So fundamentally, an employee stock option, right? This is something that might have a lot of value in the future. It might not at all. And at a certain point in time, you're going to have to actually purchase that thing. Whether you're leaving the company after being an employee for 5 years, or you're going into an IPO, or there's another type of liquidity event where you have to actually acquire those shares in order to benefit from, to have those benefits. So something that we at Dealmaker and also at LvlUp focus on is advising our startups, the startups we work with who might be very early stage, how to think about their equity, both in terms of their employee compensation, but also how to sequence their equity and how to sequence the capital they bring into the company. Because very often, if you're a company that might not be fit or might not be optimized to go public, which most companies are not, most companies also are not perfect fit for venture capital. So very often that 1000x return that your early employees might have been hoping for just is not in the cards. So something that I encourage a lot of founders to think about is, how do they create those liquidity events down the road at significantly increased valuations in order to position their company for long-term sustainability and long-term sustained growth, and get their employees liquidity. So at Dealmaker, we often focus that around large non-reporting exempt security offerings that look like Reg A, or bigger Reg D offerings under the 506C exemption, which allow for companies to create these more publicly facing offerings where they can structure their security in order to make sure that their employees are getting paid out. So sometimes we'll see this with companies who never hit the venture trajectory, never hit the IPO trajectory, but still have a sustainable, successful business. And then they're actually allowed to and enabled to allow their employees to sell their stock in a Reg CF or Reg A or Reg D506C offering, to allow them to take that cash out and go buy the house they thought they would buy. So really talking about this from the founder's perspective of creating that sequence, creating that sequence of capital that treats your employee as a, possibly even, you might think of them like a preferred shareholder, where they have liquidity that they expect. And a lot of founders don't even know this avenue exists. So they think it's IPO or bust, or acquisition or bust by PE. And very often there is this other path that we advise a lot of startups to think about very seriously. And as an employee, it's something to advocate for, and something you might even, if your founder is so inclined, you would even have the options to then sell your shares that way as well. It's a different version than what Link2 does, allowing as a primary purchaser of those equities from the employer or from the founder. Dan, that's a little kickoff, at least from my perspective, thinking about both the founder side, how do we build the strategy, and as an employee, thinking about various ways you can get that liquidity.
Yeah, that was great.
Dan, do you want to add a little bit more, go into maybe some detail around how employee stock options are often structured? Something I think you're a little bit more familiar than I am as a registered investment advisor.
Yeah, so, well, it's a pretty big topic, right? It depends on what stage the company is, but obviously, if you're coming in the very early stages, you could just be getting common stock, right? Founder level stock, as they call it. But I don't know how into the weeds we want to get in with ISOs and RSUs and all of that.
Well, something that I always find really useful, Dan, is what's the difference between an ISO and an RSU?
Sure. So ISOs generally aren't taxed when you exercise. Their gains are taxed long-term capital gains. So as long as you hold for at least 2 years, the grant date, and you at least 1 year after it's exercised. So that is, pretty much all the considerations around these things are related to taxes. I am curious kind of if the audience is mostly founders, or if it's mostly people that are early stage in a company that have received some form of incentive stock option, because the perspective, I think, varies on both.
So let me help this out a little bit from what we're seeing here at Link2. when we acquire shares in a company, and generally this is a company that's north of a $500 million investment, $500 million valuation size. Most of the risks have been baked out of it. Those companies are funded by top tier VCs. And when we speak to people, generally it's founders, co-founders, board members, and longer time employees, because it does take time for options to vest into shares. I think the first thing is to identify, one of the value propositions is that companies that are on the path to raising VC capital, obviously by nature have started off as a smaller size company, and they try and balance the equity compensation with a regular salary compensation. So the real question, I think, on the first note is, as a company that's tracking towards raising funds, how do they make that choice of equity compensation, salary compensation, on the one hand, as viewed from the company, and on the flip side, how do employees make determinations of whether that option to transfer into shares compared to outright salary would affect them moving forward? Because obviously receiving options to convert into shares, or depending on how early you join the company, shares is what's allocated. How do you make that decision as an employee and as an employer?
Yeah, that's a great question. And I think that kind of really is at the root of the discussion, because at the end of the day, it doesn't really matter that much the structure. What matters is the company going to be worth more than it is today, right? Whatever the strike price may be that you're getting shares. Everything else is kind of a bonus on top of that. But what I've seen with a lot of companies that I've advised is the primary decision point is how competitive the industry is and how capital efficient the company can operate in order to reach the next milestone. So does the company need to raise $10 million or $50 million to reach the next milestone? And that is kind of a pertinent decision to how much is offered in equity versus cash salaries. And because obviously the main reason to raise in most companies at early stages, most of that cash is going to labor, to people, right? And generally speaking, in earlier stages, if you're willing to be more generous on the equity compensation, you can get more aggressive in terms of salaries as well. But that's kind of the
yeah.
third.
And do you find that dependent on how much is raised and what they had to give up, what the founders had to give up in equity, plays a strong determination of what shares and options are offered to future employees?
To a degree, I think that's true, but there's a lot of different variables at play. So I'd be careful to say that's always the case. But to a degree, I'd say that's a common correlation.
And if we look at the part of board members of a typical company that's raising fund, how instrumental are board members in directing that choice for the founders and co-founders?
I'll
jump
take a cut at that. Yeah. So it depends on the founder, right? So I've worked with founders who have done it multiple times, taking companies public, and they know what they're doing. They are very comfortable thinking about the different stock incentive options, how to structure it, because they've gone through the whole life cycle before, and they've seen the implication of certain decisions. And their board members are usually brilliant, and usually in an advisory function. They're a founder. They know what they're talking about. They'll talk to the board and say, "Hey, is this still the contemporary way of structuring things. It's actually one of the biggest value propositions board members can have is they might be sitting on multiple boards or investing in multiple companies, and they'll have their finger on the pulse of how that particular talent market is responding to specific types of stock incentives. So sometimes the founders come in, I know what I'm doing, here's how I'm going to do it. They'll get things launched and looking for more kind of feedback and market validation from their board. Other times the board is driving. If you're a first-time founder and you don't know how to structure these things, it's okay not to know, right? I mean, there's this sort of myth of founders that you're like, every founder somehow is a CTO and a CEO and a head of and a CRO and is a registered investment advisor. It's just not true. So the best first-time founders know that, and hopefully they are able to remove their ego enough from that and get a board who has a broad perspective on the market. You know, having people who are registered investment advisors on your board or CPAs on your board is really useful to understand the tax implication. Because if you're just a bunch of entrepreneurs on your board or operators on your board who have never seen the tax implications, you might set something up that might not be right for your employees. Perfect. And on the other side of that, right, you got to inspire them.
So actually, I want to bring up now the crux of the matter, which is understanding as an employee what you have. And so when we go to founders and co-founders and boards who have had, I'm assuming they've had experience before, they've done this once or twice, 3 times before, oftentimes the next batch of employees that come in are offered options or shares, and you can explain the difference to me, to us, the difference between what options are and what shares are, and the number of different types that may exist, so that when an employee is negotiating their package, they understand what they're getting, because it gets very convoluted very, very quickly. So if you'd help us understand what is the different levels of compensation, help us understand what an option is and a share is, and what are the difference between different kinds of options and different kinds of shares.
I'll ask Dan to take that one. He's a little more qualified than I am.
Before we jump into that, I just want to go back to the board discussion really quick, because a lot of founders, when they hear, or people working at an early stage startup, when they hear board, they assume kind of the official governing board, that's officially actually managing the company and advising the executive team. That being said, you can have other boards that are equity incentivized in your company, like advisory boards, specifically to help advise you on these kinds of topics. They don't need necessarily a board seat. In fact, I wouldn't recommend having too many board members in an early stage company officially on the governing board. So I just want to say that and differentiate those two. So in terms of compensation, the two that are most commonly used are RSUs, or restricted stock units, and ISOs, which are incentive stock options. Those are the two we kind of see most commonly used as equity compensation for early stage employees to basically incentivize and reward for joining a company at a riskier stage. And if you look at the data, the amount of risk an early stage company does not reduce substantially until you're in the Series C plus kind of fundraising area. But the main differences are kind of tax treatment. RSUs are mostly taxed as ordinary income when they vest. ISOs are taxed as capital gains. So that's a substantial difference, especially since when you're joining an early stage company, it's very likely that you have a pretty high salary, because not everyone gets either RSUs or ISOs. It's generally highly valued employees at the early stages. So in this particular case, an ISO could be seen as more favorable in certain conditions, as long as certain kind of parameters are met. So you do have to hold at least 2 years from the date it's granted. And I believe it's 1 date from the exercise date. So RSUs typically are held based on kind of a predetermined schedule, where the vesting period of a year can be exercised pretty much at any time during an exercise period. Generally speaking, that's within 10 years, I believe. So ISOs also have one consideration, which you have to look at, which is the exercise price. That's typically set at least at the fair market value of the company's stock at the time of the grant. And RSUs don't necessarily have an exercise price. In terms of ownership, RSUs are basically when an employee receives ownership of the company's stock that's vesting over time. So that's a little bit different from ISOs, because ISOs, the employee actually has the option to purchase the stock. So it's not necessarily direct ownership from the get-go. You have to actually go and purchase the stock at whatever the exercise price was. Am I missing anything there, Ben, you think? That might be kind of a key consideration.
No, I mean, I think the purchase event is such an important thing for a lot of people to think about. I know I'm not exactly sure the total profile of the audience, but I remember the first time I was told I had to buy those shares.
Mm-hmm.
I was like, what do you mean? Like, I have to pay you to pay me? How is that fair? But you realize that, you know, it's a different way of structuring that incentive. And it's actually one of the biggest issues with ISOs, in my opinion, is if you're using them really broadly. Well, if you're a $65,000 a year marketing coordinator for a startup that may have taken off, you probably don't have enough money to buy the $20,000 worth of shares you might have been granted in a pre-Series A. So there are liquidity options out there for that, which are actually pretty interesting. So I know maybe, Dan, you want to talk about how do people actually navigate that purchase experience? I know you have some background in that, because it's something that, yeah.
Before we go there, though, I think what you mentioned was very important, which was the fair market value pricing of these options or shares, right? So let's start with that first. Is like, how is that price determined? Who determines that price, and what's the validity of that?
Ben, I think 409A valuations are more up your alley.
Yeah. So the fair market value is most commonly determined by what's called a 409A valuation. This is a rigorous process performed by a certified valuation professional, of which there are many. And it is a process. There's a couple of different ways to do it, and it's a bit of an art in addition to being a science. So most commonly what you're doing is you are breaking down the fundamentals of the business, and then you are valuing that business according to the proper valuation methodology for its industry. That might be discounted cash flow. That might be various other methodologies. That depends on the industry that you're in. And oftentimes how that's performed is you'll take multiple different models that you use to value a business. You'll weight them with their applicability. You'll bring them together to form that fair market value valuation. And then you have to comp them. So most importantly, you're going to say, if this is a B2B SaaS company that's a Series A with X amount of revenue and X churn, and it's selling in this industry, you then want to look at all of the other B2B SaaS companies that are in that industry that have that revenue profile, that have that churn profile at that point in time, and look at where they have been valued at other public moments. And then you're able to substantiate that fair market value, because it's not about being precise, right? Because this is a fair value. It is not an exact value. These are not publicly traded on an exchange. So there's no way for market forces to determine a precise market value. but we can use historical data and we can use industry best practices and standards performed by certified professionals to achieve that FMV of that investment.
I have several questions in regards to that. So if you are assuming that I'm an early employee at a startup company that's raising $10 million at a valuation that is arbitrary because it's art rather than science, we've got no traction of revenue, we've got no traction of users. So the fair market value is based on, hey, we're in a particular industry, we have no public records to compare against, but we'll pick a number out of the air and call it 25 cents per option. I'm assuming the fair market value, the 409A, works like 1 year of operation. You go back to your professional and says, hey, we've actually met some of our targets, our revenue goals, and we're continuing to grow. Can we do an FMV this year, 2020? Call it 2019, because I have a story here. And all of a sudden, it's like, okay, you're a B2B SaaS company. If we do comparables with larger B2B SaaS companies, your fair market value 409 goes from 25 cents to $1.50, $1.50. So now I'm hiring more employees in 2029, and I'm addressing their option value at $1.50 as opposed to my early employees, which is 25 cents. We're on the right track here so far?
Yep, I see where you're going.
Okay, now we're in 2023. And what has happened now is that I raised my 10, 50, $100 million based on a valuation of X. My fair market value when I received options was at $1.50. If I look at the public market today, the comparisons are much more challenged. So how often does a revision or fair market value happen as the economy changes?
So I'm not a securities attorney, and there are certain points in time where an FMV is required that a securities attorney can comment on. But let's talk about the market dynamics that you just brought up that are so interesting, because 409A valuations are based on comps. So, or there is a major component of the 409A valuation. And this happens to employees just as much as it happens to regular shareholders, right? That's the challenge here is if your employees hold common stock that is subject to these market fluctuations, then their stock goes up and down, just like an investor's does. Now it doesn't happen evenly, right? So it happens when there's valuing events that occur. So you don't need to do an FMV every 12 months or every 6 months. When you do it, you often end up doing it around another round. So it's oftentimes why people will try to outlast down markets, so they don't have to put an FMV out that is going to show their employees a loss in value in addition to their shareholders a loss in value. And if they can weather that storm by taking on other types of capital like venture debt or revenue-based financing, you can prevent that down event as a way to kind of even out market forces. So it's one of the things when I talked earlier about capital sequencing, preventing that down valuation when you frankly just did not need to take in new equity investment. And if you're an employee, you probably don't want to be selling that equity in that market anyway. So there are in these secondaries markets, Stripe is going through some of this right now, right? Where your secondaries, and I think I saw a question about Kraken as well, right? So there are times where private securities will fluctuate in value, and when there is an FMV out there, that helps you for the company. But there's also the more market-based fair market value that you see in secondaries exchanges for employees. That's where capital sequencing can be so important, right? As that founder, you can prevent accepting capital at a lower valuation, maybe even than the FMV in certain cases, because you can take on venture debt, you can take on revenue-based financing to weather that storm and get to a more favorable equities market.
In terms of frequency, I'll just add to that. Generally, 409As are done, I believe, annually, but they should be done anytime there's a material change in the market or in the company. So I've seen 409As done as often as quarterly in very, very rapidly growing companies.
Mm-hmm.
And no, obviously 409A isn't the only consideration when it comes to valuation. You know, certain ISOs are not necessarily bound to 409As either. So, but yeah, just want to add that.
Well, I think you bring up
So-
a great point about how you can use a 409A or an FMV to encourage and incentivize your employees, right? If you're a rapidly growing SaaS company or startup, showing your employees, hey, I didn't give you a raise this quarter, but you just doubled your, personal net worth in the last 3 months because our FMV went from 25 cents to $1.50.
Right.
Where that has two repercussions, right? So I'm holding an option. I hold options, and generally these are issued depending on the company from 2 to 4 years that the options become exercisable, being a 1-year cliff generally in a company, and then 25% every year, standard practice 4 years. If my FMV goes from, if I started off at 25 cents and it keeps going up to 150, I'm in the money because, exercising my options is costing me 25 cents rather than 150. Although in markets as we have today, if I got my options at 150, then that may not be valued, especially if my company is actually not doing so well. So my incentive as an employee with options is to force my company to accept a lower FMV. But how much power do employees actually have to do that?
Very little.
I don't know. Yeah, I was gonna say I've never heard of a case of employees being able to force a lower strike price.
Yeah.
Are you familiar with one? I would love to learn about it.
No, I'm just hypothesizing because it looks like the market is correcting, and if you read the recent news, it's going to be maybe 2 to 3 years before right pricing is achieved in the equities market, right, in the public equities market, which obviously bleeds into the private equities market. So if we're going through a correction period and the companies are refusing to revalue their FMVs, then and you see a lot of employees being laid off, right? And I want to talk about that next. It really is not fair to the employees at that point in time because they're still forced to exercise their options at a higher rate, FMV at 150, whereas now I'm outlaying a whole bunch of cash for a company that's worth much less than when I joined, but I'm still out of the money. So, I mean, that becomes a real sensitive question.
Yeah. Well, it's why as an employee in a startup, you have to, and it's one of the hard parts that I know when I talk to people who are younger in their careers and things, I like to talk to them about when they're doing their interviews to figure out whether or not to join a company. Ask investor questions. Don't just ask employee questions, because you should be treating it like you are coming in as an investor. Because oftentimes, like you were saying, Dan, if you are an equity compensated employee, a lot of your comp is tied up in the value of that equity, which means that you are essentially obtaining that value through your sweat. This is the classic sweat equity earned as an employee, and you might still be getting a salary. But if the vast majority of your compensation is coming from your equity compensation, it's not free money, right? It's not just magically there and like it's all upside. There is downside to it, or at least there is reduced upside depending on how the company is managed. And you need to ask questions like that when you're going through the interview process.
So the other question I have to ask in relation to that would be, employees are being laid off all over the place, all over the board, different sizes companies, and that's happening more and more rapidly as we see the economy still struggling to get some traction. As a person who's being laid off from a company, what are their options? Now, pun almost intended, what are their options with options, and what are their options with shares? What can they do with that?
Dan, I'll let you go as a registered advisor.
You mean specifically with like ISOs? If somebody has ISOs,
Give me an indication of what I can do with. I've got options as an employee. I'm being laid off. I had RSUs. I'm being laid off. I've been given shares. I'm being laid off. What do I do? And how much time can I do it in? And what are what are my defined swim lanes in this? What can I do? What can I do? And when do I have to exercise these decisions by?
yeah, well, the first kind of pertinent decision there is one that you brought up, which is, do you exercise your options? Because there is that possibility that the company's valuation now is below the strike price or exercise price where they were issued for you. That's a tough question, but I've encountered this with a couple companies I'm advising now, and the general kind of consensus is to look at the fundamentals of the company. So the biggest advice broadly that I can give anyone on this webinar is, if you're on the technical team, become friends with the finance team. If you're on the marketing team, become friends with the finance team. If you're on the operations team, make some friends on the finance team. You need to understand fundamentally how the company is doing. If it's making money, if it's still growing. At the end of the day, that's the primary consideration for how to strategize what you do with your equity options. At the end of the day, you're working at a startup. Valuations will fluctuate significantly. They could go down 80%, and then everything will be back to normal in 2 years. So it's a risk that you're accepting. If the company's fundamentals are strong and fundamentally they aren't necessarily losing money now during the recession, and I know a lot of companies in this boat, their valuations are down 60%, but they've actually grown in the last year, then the advice I normally give is to exercise the options and wait, because things do recover eventually, and it's just one of those things where you have to eat this uncomfortable cost in the short term for the eventual, I guess, payoff at some future point. You may be underwater in the short term. On the flip side of that, if the company fundamentally is not doing well, then that's why options exist as a structure in the first place. You don't have to exercise them.
And that's fair. I appreciate that. The real point is here, if I'm still employed with a company and I can weather the storm with my salary, those options exist for me. I have a choice. I've just been laid off. What are the conditions under that scenario?
So you've just been laid off. So normally there's a certain amount of time where you have to exercise your options. I think it's normally, it was either 3 or 12 months. I don't remember off the top of my head, but you have a certain amount of time in order to wait out and see how the company is doing in order to decide whether you're going to exercise. And generally speaking, my recommendation there is to, again, look at the fundamentals. If the company is doing well, then you want to probably exercise earlier in order to benefit from starting the clock on the capital gains. And then if they're not, waiting to exercise until, maybe 30 days before the last day. that's kind of what I've seen most people in that position do. But again, you know, it really depends on the company's fundamentals to drive most of these decisions, and whether you believe the company will recover, will reach all the milestones that internally, obviously, management has set, and so on.
And the condition of that layoff is so important, right? So if you're a very large company who's, you know, who might be pre-IPO, and you're in a down market, and you're trimming your organization to weather that storm, to get to a more favorable market, you might give those terms. So you might be 3 months or 12 months. I've seen them as short as 30 days. Oftentimes that's in smaller organizations where you're going to see like a 30 or 60 day count. I've also seen them as long as 10 years. There was a business that I was very, very early in, where we decided to pivot and recap the whole business. It was as risky as you could possibly be as an employee to purchase those shares. And the founder essentially said, and the board essentially said, look, this is the riskiest acquisition you can make. We don't know if this business is going to even exist next year, because we're totally redoing the whole thing. Give yourself a 10-year period. If it all works out and the pivot is successful and everybody needs to come back, you're going to get to buy in at like 2 to 4% of the company for practically nothing. Congratulations. If it goes away next year, you don't have the risk, and you didn't feel like you had to jump at that opportunity, because that's really where I have a lot of sympathy for employees who are in a really hard situation, is you are taking on an investor position of, do I really believe these shares are going to be worth more or less in the future? And when you probably started that job, you never thought you were going to have to treat your compensation like you were an investor. And that is a different mindset. And it's something that a lot of employees, frankly, are not capitalized to do that. So there are options to get loans to purchase shares like this, especially in up markets. There's a lot more liquidity just to help you support those things. But for a lot of employees, it's a very tough decision.
Thank you. So actually that brings up a lot of points, but I do want to touch one more thing. We've covered RSUs, ISOs, FMVs. I do want to talk about, we've covered 409As. We're going to cover one more point and then we'll get to the questions. Explain to us what ROFR means. Because I, as an employee, can decide that I want to sell my shares or convert my options to shares. Then I've decided I'm a seller, I found a buyer, and then it goes to a process called ROFR. What is that?
Well, it's the right of first refusal.
By whom and what happens? So
typically by a preferred shareholder, where they have the rights to, I mean, there's a couple of different situations where ROFRs can apply. If you are offering a new investment round, right? So let's say you brought in a small VC in your Series A, and as part of their term sheet, which you might not have even cared about because you were just so happy to get an investor in the door to keep your company alive, they may have had a right of first refusal for future events, which then means if you're now offering a $20 million Series B, that VC, that institutional investor, has the first right to take that capital. And if they refuse, then it opens. It is quite literally, they have the first right of first refusal for that investment. That's usually the most common case.
Yeah, and I'll just add that it's normally not in excess of just maintaining existing ownership.
Right. So
it's not like if a new round opens for 50 million and you're the ROFR as a lead VC in the last round, it's not like you can take all 50 million necessarily. You can take enough.
Right, you can protect your pro rata position.
Exactly.
Okay. So we've gone down this path, and it gets a little bit complicated. As a new employee to a company that's in a startup, I have to look at, as an employee, not am I looking at as my value to receive compensation in cash, right? Salary. I have to look at the company as an investment and as an investor, because that is how I'm judging the company to take that position. What am I being offered as equity rights in the company now and in the future? how should I be valuing that? And that's a really good point that we should all be looking at as we join this company. The kind of shares that are allocated to me, whether they're restricted stock options or incentive stock options, restricted stock units or incentive stock options, ISOs, is an important distinction in with what I can do with those shares, given a time frame in which I'm with that company. These are generally worked through, the valuation is generally worked through a 409, fair market value. And then if I do decide that I want to sell something, I have to give that option to the board and to the company to make that purchase first, which is called the right of first refusal. We looked at the RSU and ISO having different tax consequences. So make sure that we as employees exercising, or founders or board members exercising our options, we need to understand what the tax implications are with those that exercise. Keeping in mind that there's a broader, larger consideration of where the company is heading, that will determine whether you should actually be exercising any of these options and shares, because it does mean you're out of cash to exercise that right. And the real question is, are you going to make more money having exercised that right or not, or whether you're going to be out of pocket? If the company is going downhill, then as an investor, you have to make a decision to walk away from that investment, unfortunately. I'm going to go through some Q&As. James asks, early stage investors direct here and also advisor options in startup unlikely to IPO. I don't know what the question is. Early stage investor direct here and also advisor options in startup unlikely to IPO. I don't know what that means. The one from Robert, is there any guarantee that a company's private pre-IPO shares will be given equal value treatment to IPO shares if the company goes public?
It's a really interesting question. There's not a lot of situations where a pre-IPO share would be valued greater than an IPO, share price that's projected, because that would probably not, IPO would be a challenging path if that were the case. It does happen. Oftentimes what you'll end up seeing, and so this is a situation that I work with pretty frequently at Dealmaker, is there are companies who, when they do end up going to an IPO, not everybody IPOs on NASDAQ or the New York Stock Exchange. It might be IPOing on the Australian exchanges or the Canadian exchanges or those exchanges in Europe, where sometimes you end up kind of trading much lower than you might have traded in a private market. So there are a lot of situations where the board will actually issue a security. In the US, this is a Reg A security. There's corollaries globally. To price that security at an attractive rate in order specifically to provide liquidity to employees, because they believe that once it hits an exchange, it might trade favorably for a short period of time, but eventually it will trade lower than that price. So very often, as part of that capital sequence pre-IPO, you create an employee-focused liquidity event or a board-focused liquidity event in order to bring a bunch more of those shares into either other holders or even onto the board. So sometimes they'll do a stock buyback where the company will actually purchase those shares back from employees in order to then IPO. So there's remediating options for the company if they're in that situation. As far as guarantees of pricing, I don't know. I've never heard of anything in an employee stock incentive program that protects from the IPO being at or above their grant price, though.
Okay, so I do have a question here that was in the chat. I will omit the name just because it might be private, but it's a good example of what people may be going through at the moment. And I'll just read the question. If I bought, let's say, $20,000 of Kraken stock pre-IPO, we know that Kraken's still private. How can I sell 10,000 of that back? You know, they bought 20, want to sell 10 back. The company seems to be taking a long time to become an IPO. Liquidity is tight. The market is shrinking. What if I can sell half my shares, but let's say they're only worth 9,000 now? Can I sell them for 9,000, and how does that work? I need a buyer, obviously, since there's no market, since it's pre-IPO, which is the whole point. But that's what you're talking about finding for us, right? So
Actually,
generally, yeah, go ahead.
I'm sorry, Corinne. That question about the Kraken, I sent an answer to the person who asked it. It has to do with the way shares and equity is handled on the Link2 platform.
Okay. And then the next question: in reading the SEC and IRS rules, 409A valuations appear to be for non-qualified stock options. ISOs are a different category, which is qualified stock option. So why does a 409A valuation apply to those?
So it doesn't, to my knowledge. It's specifically for RSUs, and 409As primarily are used for the investor. So it's primarily in the case of I am offering a priced round and I need to substantiate that pricing, especially if you're looking at things like Reg CF or Reg A, where they're actually securitized offerings, or on a Reg D 506C. Performing a 409A valuation for the investor is going to be a very good idea. It's going to help that investor feel confident in the pricing that you've put in place, which is different, of course, than like a lot of times in a venture round where that pricing is being performed by an institutional investor, where your 409A doesn't matter because they're going to do their own with their own pricing and their own evaluation. So there are certain cases where 409As do have implications for the employee stock options, but the larger use case is related to pricing the investment.
And I just want to say to the folks that are here, there are a lot of questions that come up about pricing, taxing, pre-IPO companies becoming public companies. There is in the chat, please repost it. There is an event in 2 weeks that we will actually speak with someone who's gone through the full experience of being involved in the startup. It has a financial background for CPA, then taking the company public, and we can answer some of those questions that we had here in more detail. So join for that next event. But before we go there, has anyone looked into the outcome of equity compensation during the Twitter layoffs? How did it fare for the employees? Anyone know? Did employees have a fair equity rights option?
I am not familiar, and I won't comment.
Okay.
Yeah, I'm not familiar with the Twitter situation.
Then the next question: who can I reach out to for selling equity for a private company? Now, obviously, if you're 500 million, if you're working with a company that's over $500 million worth of valuation in a sector that Link2 thinks is continuing to grow, reach out to us. And I'm sure that you can reach out to Ben and Dan for any questions related to that as well, because that's what they do as well.
Yeah.
Sure.
Yeah, happy to help.
Yeah, obviously Link2 is a great option in that particular case. And you can find a broker for virtually any other situation, even if there's significant lockups on your equity. You know, you can do things like 00 SPVs and forward contracts. Where there's money to be made on commission, a broker will do it. So lots of opportunity.
Okay, I'm going to go to another question here, and that's the final question for today. I'll respond to that. Generally, it relates to I haven't for investors on the Link2 platform. There is a question about what do I do? Obviously, Link2 has been involved with acquiring secondary shares. We then put those companies on our on our platform, and you can buy into Link2 those companies. And so really the question is, how do I, if I invested early in any of these companies on your platform, how do I find liquidity as an investor on the Link2 platform? And that's a really, really good question, because when we were developing Link2, it was all about finding liquidity in this very illiquid market, which goes everywhere from the early stage, early rounds of angel, right up to pre-IPO unicorn companies. We do not invest in companies that are smaller than a $500 million valuation. So you're invested in a company today that is well positioned to exit in some fashion. Obviously, the markets are challenging at this point in time, so we'll see a little bit of a slowdown in the IPO market. But that doesn't leave you, investor, out in the cold, because when we were developing the business model, it was all about creating liquidity in this environment. So we have an ATS, alternative trading platform, that is going to be released. We're right now in beta, which allows you as an early investor who made investments in Link2 to find liquidity, even though the company hasn't gone through an IPO. So once that platform is released, ATS, and actually we'll be having a Link2 Learn session in that end of March, early April, that will describe the process whereby you can find liquidity on our platform for the early investments that you made on the companies on our platform. So it's a member-driven liquidity platform that you can engage with us when we release the liquidity platform for you early investors in companies that we have on our platform. So I hope I answered that question well. I think thank you, Dan and Ben, for your time and expertise in sharing with us. We're at that time. I know there are a few more questions, but I wanted to give you the opportunity to take back to recover, Dan especially. Ben, I don't hang out with Dan for 3 or 4 days, and
Yes, avoid me.
Avoid.
How am I supposed to
Dan
avoid him?
I hope you get better. I hear wine from Napa or Sonoma is very good to cure all ills.
I heard that.
If the ill is not cured, at least you'll be drunk enough not to know that you're sick. So yeah. There you go.
I just want to say, I don't know if the audience has our contact information, but I'd be happy to kind of, and I'm sure Ben will extend this as well, to share our email and answer any questions there. Because, oftentimes with stuff like this, whenever a question comes up, there's 2 things that always pop in my mind. One is I need to know like 100 more things in order to give proper advice, because there's so many variables and parameters. And two, I need to think, can I legally answer this? So yes. Some of these things, it's better just to do it with a paper trail. So I'd be happy to do that with anybody that joined on the audience today if they have more detailed questions.
So are you okay with us share, because there will be a thank you email going out after this event with the recording. Can we share your emails on that thank you note?
Yeah, absolutely.
Absolutely.
Perfect. Shelley, did you want to close this out or?
No, I just came to say thanks, guys. It's really great.
Thank you, everybody, for joining. It's been a pleasure having you here. Hopefully, we answered your questions. If we didn't answer all your questions, hopefully, we create an opportunity for you to have some questions that need to be answered, because it gets complicated. And when things are good, everything seems to be heading in the right direction. When things get a little bit sour, there are more questions that need to be asked and answered. If there's something that we missed today that we didn't get to, do let us know. You will have our invite, you have our emails. Just let us know that we missed a question or two that's important for you. And we'll have a response for you all as best as we can, with the caveat that Dan just put is sometimes we don't have the qualification to give an answer that you can take to court. And you may want to find a financial advisor or tax advisor or your spouse, because they'll be the strongest advocate for you. Ben, Dan, thank you so much. We hope to see you guys in a couple of weeks at our next event, which will talk a little bit more about tax implications, the understanding of how these things are priced, what it means to find liquidity, what some of the caveats are, and that'll be liquidity 1 or 2 or something like that. Or actually, the title is the IPO market sucks. What happens next? I'm an employee with a private company. There might be a long-term to exit. It looks like valuations are going down. How do I manage this? financially, emotionally, economically. So we'll answer those questions next time. Thank you, Ben. Thank you, Dan. Thank you, everyone, for attending. Thank you for the Link2 team. Much appreciated. Bye.
Thank you all. Bye-bye.
Thank you, everyone.